It's been a tough few quarters for Tata Motors, whether it's JLR and its impact on COVID, whether it was the impact on global supply chain, production-related hurdles, etc., or whether it was the domestic CV space or the PV business, which continues to be pretty much under pressure. But looking at all of those factors and looking at the numbers that they've managed to deliver, especially on the back of their very tight and aggressive cost control measures, Tata Motors has actually delivered a beat on all counts as far as the Q2 performance goes. Let me read out the numbers real quick. Revenue from operations came in at 53,530 crores, a degrowth of 18%. A loss came in much below what we had expected, though it still is a loss figure of about 307 crore rupees. EBITDA was down 13.5% at 6,098 crores. And if you look at the margins that we calculated finally, it's a healthy expansion on a YOY basis, 11.4% versus 10.8%. And even sequentially, of course, given that Q1 was a complete washout quarter, it's a very good improvement on a sequential basis as well. They've talked about how they expect gradual recovery of demand and supply in the coming months. Of course, they reiterated the fact that they're very, very committed to achieving near zero automotive debt in the coming years. The focus on front-end activations, product range, executing cost and cash savings, that is the biggest focus for the company at this point in time, whether it's the India business or whether it's JLR. In fact, they've attributed the improvement in their performance also largely to the tight and aggressive cash control measures that they've taken. Mr. Balaji, the CFO of Tata Motors, also talked about the demand for PVs that's playing itself out, especially ahead of the festival season. He says it's not just pent-up demand, there's definitely much more to that. He's blown away with the October demand on the back of Navratri sales. They've seen highest ever booking, highest ever demand. In fact, they don't even have enough production to meet the demand, he said quite blatantly. With the current demand scenario, they would of course love to have more hours in a day to produce, but they also talked about the fact that they're in talks with several potential partners for the PV business. It's already started to show good demand and it will continue to do so. CV is fully not back on track yet. While PV business is firing on all cylinders, according to the management, they've started the cash saving plan for India markets. It has started yielding them results as well. They've arrested EBITDA decline. EBIT break even has been achieved. They're pleased with the performance despite the uncertain climate. Now talking about the JLR performance and its outlook. As far as the numbers are concerned, PBT came in at £65 million on revenues of £4.4 billion. They've achieved a 0.3% EBIT margin, which reflects a good recovery in sales, project charge plus and cost efficiencies that they put in place. Margins improved as well, with EBITDA margin coming in at 11.1%. The retail sales for Q2 were at about 1.13 lakh. It was up 53% sequentially, but on a YOY basis it was still down 12%. They remain a bit cautious given the uncertainties on the back of COVID-19, Europe and UK related trading arrangements. But yes, they expect recovery in sale, revenue and profitability likely to continue in the second half, primarily driven by project charge. They also continue to expect positive free cash flow over second half of the year. So overall, they said UK and China sales are back to pre-COVID levels. There's some supply shortages in the US, but it's likely to improve from here on, even in the other overseas regions as well. They expect modest growth for the industry. Tight cost controls is something that they're betting on, and they're absolutely on target to achieve that £2.5 billion worth of cash savings in the current fiscal year. So overall, the commentary is I wouldn't say very upbeat, but yes, they are talking about how the initiatives taken so far have yielded good results, which we can see reflect quite evidently in the numbers as well. And going forward also, they said they seem to be completely on track with their cost saving and cash saving targets. So let's see how the stock reacts to that, but largely it's a definite beat on the performance.